6 new dividend increases you need to know about. Most of you know that Warren Buffett's 1988 Coca-Cola investment yielded 56.6%, doubling his initial investment every 2 years. This income supports new investments. To initiate the dividend snowball effect, focus on stocks with consistent dividend increases. In this video, I'll tell you about 6 dividend stocks that recently upped their dividends, earning me thousands of dollars. Let's begin with the first dividend stock on our radar, Chubb Limited, which recently announced a dividend increase of approximately 6%. Chubb has been making waves in the news lately, largely due to Warren Buffett's Berkshire Hathaway taking a significant position in the company. Checking Buffett's portfolio on Datarama.com reveals that Chubb Limited now holds the 9th spot, representing around 2% of his entire portfolio. The company has demonstrated impressive growth over the past year, with a notable 36% increase further boosted by Buffett's investment announcement, causing a 7% surge in the stock price within the last month. Buffett's strategic affinity for the financial services industry, especially insurance, is evident through his diverse portfolio, which includes major players like Bank of America, American Express, and Visa, among others. These holdings complement Berkshire's insurance agents like Geico and General Reinsurance Corporation, which are pivotal revenue drivers for the conglomerate. Buffett's attraction to Chubb likely stems from the reliability and predictability inherent in insurance businesses. The consistent demand for insurance services, whether in healthcare, property, or vehicles, ensures a steady stream of revenue. Additionally, insurance companies typically invest a portion of their capital in secure assets like bonds, contributing to stable cash flows, a characteristic that aligns with Buffett's investment philosophy. Chubb's consistent growth in free cash flow and dividends over the past 2 decades reflects its ability to generate robust profits and reward shareholders, further solidifying its appeal to Buffett. In the current market climate, characterized by heightened interest in areas like artificial intelligence and pharmaceutical breakthroughs, Chubb's stability and dependable cash flow position it as an attractive investment option. Moreover, with a price-to-earnings or PE ratio of 11.8, Chubb appears undervalued compared to the broader market, offering potential for value-oriented investors. Considering these factors, investing in Chubb may be prudent for those seeking stability amid sectoral volatility. While it may not evoke the same excitement as tech or healthcare stocks, its reliability and favorable valuation make it a compelling choice. What are your thoughts on following Buffett's lead and investing in Chubb? Tell us in the comments below. Next on our radar, Parker Hannifin, recognized as a dividend king for its exceptional history of increasing dividend payments over 50 consecutive years, recently announced a notable 10.1% boost in its dividend payout, defying typical expectations for such companies. This increase comes amidst a period of outstanding stock performance, with a remarkable 64% rise over the past year. Year to date, the stock has surged nearly 15%, despite experiencing a slight dip of approximately 4.2% in the past month. Scheduled for June 7, 2024, Parker Hannifin will distribute a dividend of $1.63 per share, with an ex-dividend date of May 9, 2024. Operating across diversified industrial and aerospace system segments, Parker Hannifin serves various end markets, with approximately 40% of its business conducted internationally. Since 1957, the company has consistently increased its dividend payment, showcasing its commitment to shareholders. Presently, it boasts a 12-month trailing dividend yield of 1.07% and a forward dividend yield of 1.18%, indicating anticipated dividend growth. Despite the current yield nearing a 10-year low, Parker Hannifin demonstrates impressive dividend growth rates, 15.8% annually over the past 3 years, 13.7% over 5 years, and 11% over the past decade. With a payout ratio of 0.26, the company retains a significant portion of earnings for future expansion. Its profitability rank of 9 out of 10 underscores robust earnings potential, supported by a decade of positive net income. Bolstered by robust growth metrics, including strong revenue per share and impressive 3-year EPS and 5-year EBITDA growth rates, Parker Hannifin emerges as an attractive option for investors seeking stable dividend income alongside growth prospects. Next on the list is Portland General Electric Company, NYSE-POR, a utilities company based in Portland, Oregon. Recently, on April 22, Portland General Electric announced a 5.3% increase in its quarterly dividend, which will be payable on July 15 to shareholders of record as of June 24. In its Q4 earnings call in February, the company discussed its guidance and dividend growth policy. Portland General Electric expects 2% to 3% weather-adjusted retail load growth in 2024. This forecast, along with regional investments in incoming projects, supports their confidence in long-term load growth, maintaining a 2% growth guidance through 2027. The company anticipates operating and maintenance (O&M) expenses ranging from $815 million to $840 million, including $165 million for earnings-neutral regulatory deferral amortizations, wildfire mitigation, and vegetation management costs. Excluding these items, the midpoint of their O&M expense range represents a 3% compound annual growth rate compared to the 2022 base O&M expenses, adjusted for similar offsets. Portland General Electric remains dedicated to optimizing productivity, delivering high-quality customer service, and managing operating costs effectively. Their approach, combined with risk mitigation efforts and critical investments made in 2023, reinforces their confidence in their growth plan. As such, they have reiterated their long-term earnings and dividend growth guidance of 5% to 7%. With 16 hedge funds currently investing in Portland General Electric, the company is well-positioned for continued growth and stability in the utility sector. This consistent performance and proactive management make Portland General Electric an appealing choice for investors seeking reliable dividend growth and a stable financial outlook. Coming in at number 4, we have Nasdaq Incorporated, Nasdaq NDAQ. This financial services giant recently announced a 9.1% increase in its dividend on April 25. As of the end of 2023, 30 hedge funds, including Thomas Tyer's Ferallian Capital with a $382 million stake, held positions in Nasdaq Incorporated, according to Insider Monkey's database of 933 hedge funds. Nasdaq Incorporated is a notable addition to our list of companies with recent dividend hikes. Hedge funds are also showing interest in other robust dividend stocks like W.W. Grainger Incorporated, NYSE GWW, MetLife Incorporated, NYSE MET, and Parker Hannifin Corporation, NYSE PH. In its Q4 2023 investor letter, Times Square Capital U.S. Midcap Growth Strategy highlighted Nasdaq Incorporated's solid performance, which can be attributed to its strategic initiatives and strong market positioning. Nasdaq has demonstrated consistent growth, making it a reliable choice for investors looking for stability and dividend income. Moving on, our next company with a significant dividend increase is Ralph Lauren, which ranks 5th. The company announced around a 10% dividend hike, marking another substantial increase. Over the past year, Ralph Lauren stock has performed exceptionally well, up around 67%, with a year-to-date increase of over 25% and an 8% rise in the past month alone. Despite a history of at least one dividend cut in the last decade, Ralph Lauren's recent performance shows promise. The company's earnings per share, or EPS, are forecast to expand by 50.4% over the next year, with the payout ratio potentially reaching a substantial 21%. With a compound annual growth rate, or CAGR, of approximately 6.5% over the past decade, Ralph Lauren's dividend growth is notable, though its past cuts suggest some caution for those relying on dividend income. Overall, Ralph Lauren's strong EPS growth of 14% per year over the past 5 years, combined with a low payout ratio, indicates ample room for future dividend increases. This makes Ralph Lauren a compelling option for income-focused investors. And finally, let's talk about a favorite among dividend investors, Realty Income Corporation, NYSE-O. This real estate investment trust, or REIT, just announced a modest 2.1% increase in its monthly dividend. However, it's essential to understand that this 2.1% bump doesn't reflect the full picture. Realty Income has a unique approach to dividends, increasing them every single quarter. Now, diving into performance and dividend history, Realty Income has faced some challenges over the past year, down approximately 11.3%. Year-to-date, it's down about 8.72%. But when it comes to dividends, this company has a solid track record. They not only pay dividends monthly, but also increase them quarterly. While these quarterly increases might seem small, they add up over time. Year over year, Realty Income's dividend growth is closer to around 3%. Looking at the dividend breakdown, Realty Income boasts an attractive dividend yield of about 5.88%. However, what's crucial for REITs like Realty Income is the adjusted funds from operations (AFFO) payout ratio. This metric tells us if the dividends are sustainable. Currently, Realty Income's AFFO payout ratio sits around 74.62%, indicating that the dividend payments are safe and sustainable. Now, it's worth noting that Realty Income has been increasing its outstanding shares significantly over the past decade. While this might raise some eyebrows among shareholders, it's a common strategy for REITs, given their obligation to distribute a significant portion of earnings as dividends. With limited options for reinvestment, issuing new shares becomes a way to fund growth initiatives. While increasing shares outstanding isn't always ideal for shareholders, if it contributes to healthy growth, it may be justified. So there you have it, 4 dividend stocks that recently announced dividend increases. What are your thoughts on these companies? Share your comments below, and don't forget to like and subscribe to the channel for more insights like these. Thanks for watching.